right, ladies and gentlemen, we'll go to those stories in just a bit, but I'm told that CEA, V A Nageswaran, is, of course, addressing a gathering. He's talking about India's Q2 GDP. Let's cut across and listen into what he's saying.
Q2 of last year, and then it was a very tepid 0.4, 0.6, and then 2%, improving to 2% in the first quarter of the current financial year, further picking up to 3.5% in the second quarter. That is a bright spot. The other bright spot is construction. We can see that construction sector over the last full year has been growing at very high single digits and continued that growth rate in the first half of the current financial year as well. These are the bright spots. The bulk of the slowdown, as you can see from the chart, has been predominantly due to the manufacturing sector, which was also a global phenomena. And some of it is partly due to the presence of excess capacity elsewhere and imports dumping in India, and naturally the manufacturing process slowed down. You can also see that in the fact that the consumption of steel went up, but production of steel did not go up. It was inventory drawdown. So these were some special factors that played a role in exaggerating or amplifying the growth slowdown, the growth rate slowdown in the second quarter. So therefore, some of it may not necessarily continue or may not continue at the same pace in the subsequent quarters. If you look at the 5-year, this is to take a big picture view, because if you look at Q2 of the last 3 financial years, you can see that the Q2 growth rates of agriculture, forestry, and fishing, while it has been slower, if you take a 5-year view, as I pointed out, in the near term, after the last year of tepid growth, there has been a pickup, but it is a 5-year growth rate, which includes naturally the COVID year as well. Industry in general is improving if you take a longer term big picture view. Same is the case with manufacturing, although second quarter was problematic. Electricity, gas, and water supply, all of which was tepid in the second quarter, but on a longer term view, there is a steady trend improvement that is going on. As we also mentioned in the case of construction, services sector growth has been steady. And therefore, in general, GBA at basic prices, the 5-year CAGR has been rising over the last 3 financial years in Q2. On the demand side, if you look at it, total consumption growth is the 5-year CAGR, annual compounded annual growth rate was 3.6 last year, holding steady at 3.5 this year. Private final consumption expenditure remaining steady at 4.4. The gross fixed capital formation, obviously, even though the second quarter, and we will talk about it later, was disappointing, especially the first half of the current financial year, having witnessed a slowdown in the capital expenditure of the public sector in the country as a whole. But by and large, I think the recovery in the gross fixed capital formation after the second decade slowdown is continuing. Exports of goods and services is again is on the improving track. Import of goods and services is actually slightly lower or steady, and therefore the 5-year GDP growth rate is in real GDP or GDP at constant prices is improving at 4.4% compared to 4.2% in the second quarter of last year. In order to give you some context, because bulk of the slowdown in the second quarter from the supply side, because it is attributable to the manufacturing slowdown and also the slowdown in mining and quarrying sectors, because if you look at the production of the 3 items, by the way, I wanted to point out to you that for the first time on this call, we have the Additional Director General Sanjay from the Ministry of Statistics. He's virtually present on this call. And sitting alongside me physically in my room, we have the Deputy Director General, Mr. Dilip Kumar Sinha, of the National Income Accounting Division, NAD, of MOSPI, is also physically present here. And I think going forward, we will have officials from the Ministry of Statistics with us in these press conferences, so that questions related to statistical estimations, they will be able to shed more light and offer better perspectives than I will be able to do, since I will be coming from the macroeconomic angle. So I just wanted to inform you about the presence of these two officials on the call, and my sincere thanks to them for being here. I think advanced economies, I talked about the fact that manufacturing and mining have been principal causes of the slowdown, and especially coal, natural gas, and crude oil constitute nearly 50% of the mining sector, and they have been tepid in the second quarter, and that is the reason. But if you look at the global scenario, you can see in the second quarter, manufacturing purchasing managers indices came down below 50 in the European Union, and also globally in general, it was below 50, whereas in the case of India, it has remained above 50, emerging, as you can see on the right side of your chart. So there is an impact coming from the global supply chain uncertainties, partly because of the unexpected growth under recovery in the in China, which also led to concerns about higher imports from that source, from that country, which would have also had an impact on domestic prices and therefore domestic manufacturing. And some of you may recall the press conference and statements made by Mr. Narendran of Tata Steel in this regard not so long ago. And also geopolitical risk and uncertainty flared up in the second quarter, leading up to the presidential elections in the United States. More importantly, there has been a very big spike in trade uncertainties as the election season progressed in the United States. So, and the global supply chain pressure index also went back up below zero. So we want to put the second quarter slowdown, which is, while most of us anticipated it, in the light of the excess rainfall and therefore lower footfalls in purchase of consumer durables, and also some religious observance days falling fully in the month of September, we wanted to give you some more perspective on the higher than expected decline in the growth rate, which is the second derivative, and global factors play a role, and some very specific sectors in India within manufacturing and mining are also playing a role. So one should be able to interpret the slowdown, therefore, in the right perspective. And that is why these global developments naturally showed up in the suppliers' delivery times index becoming slower, and also growth in new export orders moderated much more sharply in the case of India's manufacturing goods. So there is a shadow or a spillover from global factors on domestic manufacturing, which is what we see in the data as well. But however, what we need to focus on, remembering the fact that we are already 2 months into the third quarter, and the current financial year is barely 3 months and a week away from concluding. But I think by and large, we should expect to see the growth in second half of the current financial year when it is reported. We will get the first estimates in January, the advance estimate, and then the first preliminary estimate in February, and of course the other estimate in May as well for the full financial year FY25. So what we are seeing in this slide is the fact that Kharif production has been very high, both in the food grains, in rice, and also there is higher MSPs, which should incentivize Rabi sowing. Storage reservoir, water storage in reservoirs is very adequate for the Rabi crop, and fertilizer availability is at comfortable levels. So the kind of pickup in agricultural sectoral growth that we have seen in the last 2 quarters, we expect it to continue in the second half of the year as well. Industrial activity, as we said, continues to pick up in the expansion zone, and I think fuel consumption, as you can see in the bottom table, compared to July, September. October was higher, and so was power consumption. And the uptick in e-way bill generation from 10.9 to 11.7 from August to October is also encouraging. Services sector continued to be resilient. Services sector PMI is being consistently in the expansionary zone, and UPI transactions, both volume and value, have seen a sharp uptick in October, and there is double-digit growth in air cargo activity while port traffic remains steady. Moving on, I think we all know that the passenger vehicle sales in October helped the industry clear a lot of inventory, two-wheeler and four-wheeler sales, and domestic air passenger traffic handle has not only seen a level shift up in the volumes compared to the previous 2 financial years, but you can see the slight upswing on the right side of the right side chart in the green line in September and October as well. Rural demand has been a bright spot, as we have been writing in the monthly economic review, which we publish around the third week of every month. On the left side, you can see about 7 consecutive quarters of growth in rural demand based on the Nielsen IQ data, and two-wheeler and three-wheeler sales as well in rural India, while tractor sales is at an all-time high because of the expectations of a good Rabi crop on the back of a Kharif crop as well. Inflation in general, apart from very specific items in the food sector, in the food category, and also precious metals, in general, it has been on the lower side. And the Indian Institute of Management, Ahmedabad's inflation expectations, business sector inflation expectations survey has been pointing to declining inflation expectations rather than rising inflation expectations, confirming the fact that there are no second round effects coming from higher food prices, which in any case is concentrated in a few commodities. When it comes to the external sector, while the second quarter GDP data show that export growth indeed slowed down, I mean, we have seen that the export growth rate is 2.8% year on year compared to 8.7% in the first quarter. The fact remains that outside of petroleum, gems and jewelry, merchandise exports are in high single digits, and together with services, this core merchandise exports, excluding petroleum products, gems and jewelry, and together with services, we have seen 10.8% growth in the first 7 months of the current financial year compared to the 7 months of the last financial year. So I think in general, towards when the full year's data is out, we will see that net exports would have made a good contribution to overall economic growth than in the previous financial year. Yes, we are aware of the fact that in the month of October, there was profit taking or profit booking in the Indian stock market by foreign investors, also partly because of renewed excitement about China, shifting of some capital out there. But by and large, if you see on the left top chart, both gross FDI flows and net FDI flows are doing far better than they were doing last year so far in the first half of the financial year. And Indian domestic investors, both institutional and retail, continue to have faith in the Indian capital markets, providing it a certain measure of support and undergirding, so to speak. Well, there is concern about capital formation based on second quarter data. However, that is what prompts us to dig a little deeper and go into what's happening on the underlying drivers of capital goods. If you look at the capital goods imports.
If you like this video, then like, share and subscribe to ET Now.